Hey, welcome back to Korean Economy Insider.
So there's been some really interesting stuff happening in Korea lately around financial policy.
Yeah, absolutely. We're going to focus today on a pretty critical tool that the government is trying to deploy right now to manage its foreign exchange situation, which has felt, well, let's just say a little urgent recently. Specifically, we're dissecting the proposed changes to the Repatriation Investment Account, or RIA.
And this account is it's a really powerful mechanism. It's designed to do two big things. First, lure capital back from overseas stocks, and second, redirect it into the domestic market. And it's all sweetened with this huge tax break, non-taxation on capital gains up to 50 million won.
Right.
So the central question, and it's what policymakers are struggling with, is this. Should the Ministry of Economy and Finance broaden the scope of this RAI to include things like bond ETFs or even just cash to get more people to participate? Or should they keep the criteria really strict, focused on domestic stocks to maximize the local market stimulus and, prevent misuse of the subsidy?
Yeah, and for me, I'm firmly on the side of expansion. I just think it's a necessary, pragmatic step that accepts the reality of how investors are feeling right now. The priority has to be maximizing participation to stabilize the foreign currency situation. We need those dollars back in Korea, and if that means offering a safer place for them to land, so be it.
And I guess I'll be taking the other side here. I'm going to insist on maintaining those strict, high-bar investment criteria. I just think diluting the requirement compromises the whole point of the subsidy. If you're going to grant a 50 million won tax exemption, that benefit has to be tied to a productive, long-term commitment. Anything less it risks turning the RIA into a general tax shelter instead of a tool for stimulating our equity market.
Look, my argument really just boils down to the reality on the ground right now and what the government clearly sees as its most pressing issue. The success of this RAI policy, is measured by the sheer volume of foreign currency, specifically dollars, that comes back into Korea. Why? Well, to urgently stabilize the won-dollar exchange rate, which has been under a lot of pressure. Now, while the tax exemption is an undeniable carrot, we have to acknowledge the current mood of the average retail investor. They're risk-averse. They've seen volatility everywhere. So forcing them to commit 100% of their repatriated money into domestic stocks, which have their own volatility issues, that's a serious deterrent. The government's being smart by even considering some flexibility. The idea is to maybe allow a portion of the proceeds, say 30% if 70% goes into stocks, to be held in bond ETFs or even just cash. That balances the desire for domestic investment with, basic investor comfort. That psychological safety net is the only practical way to get enough capital flowing back.
Okay, I get that. I see why the immediate FX volume is front and center for you. But I would frame the core purpose of this tool a little differently. The specific action we're talking about, offering non-taxation up to 50 million won, that's not just an FX tool. It's fundamentally an economic subsidy paid for by the taxpayer. And that subsidy should be strictly tied to a beneficial outcome, which is stimulating the domestic stock market and securing long-term productive investment right here in the Korean economy.
Right.
If we let investors just park a big chunk of their funds in cash or some low-risk debt, they get this huge benefit from the tax break without taking the required risk in the local equity market. This whole structure risks what people in finance are really worried about, what we call non-taxation cherry picking. That means investors grab the benefit by, doing the bare minimum, and then they just cycle their money right back out to overseas stocks or spend it. We know the Ministry of Economy and Finance is deeply concerned about this stock churning strategy. They've already promised to thoroughly prevent it by checking investors' total overseas holdings. The fact that they have to police it so strictly suggests the rules should just be tight and clear in the first place.
That brings us right to the core tension, doesn't it? Our first contention, balancing FX stabilization versus investment purity. I still argue that data clearly supports prioritizing FX stability right now. We are seeing these massive shifts in capital that show a really deep-seated risk aversion among investors.
Okay.
Look at the figures. Recent data shows personal dollar deposits hit $12.73 billion. That is the highest it's been since the end of 2021. So investors are already hoarding dollars. And beyond that, we've seen astronomical numbers for gold and silver sales. Gold bar sales were over 4 times last year's total. The silver figures are even more staggering. I mean, that kind of frantic buying of precious metals is concrete proof that investors are worried about stability. So to lure capital back from overseas, the policy has to cater to that conservative mindset. Allowing safer assets ensures they bring their money home first, which is what officials have repeatedly called the crucial factor.
I appreciate you leading with that FX data. It's compelling. But that specific psychological safety net you mentioned, allowing cash holdings, it comes at a direct cost to the taxpayer, and I think it fundamentally compromises the policy's integrity. Let's go back to the cost of the tax relief. This benefit is a subsidy meant to change behavior in a specific productive direction, right? Right. So if we allow, say, 30% of that money to just sit in cash, the government is essentially using public funds to subsidize sheltering dollars, not to fuel the cost by OS COSDEC. The incentive has to mandate a significant productive capital commitment to justify a tax-free status. If the funds are just parked in cash, they could just as easily be held somewhere else without demanding such a high-cost incentive from the government.
But if we hold that line so strictly, we risk failure on the main objective. Government officials are clear. They need the volume of capital back. If we demand too high a risk exposure, like 100% equity, the Seoulhakgaimi, the Korean investors in US stocks, they might just keep their money overseas. Pragmatism says we should take the win on repatriation first. A smaller percentage in domestic equity, but with a huge influx of dollars, is way better than a perfect mandate with $0 coming back.
Pragmatism, yes, but we also have to think about the risk of loopholes and abuse. And that brings us to our second contention. Allowing cash or highly liquid debt makes policing this whole thing, it seems virtually impossible to do without becoming overly intrusive. If the policy is too loose, the government has to start policing investor intent. That means looking at someone's total overseas stock holdings to figure out if a transfer is just a tax dodge. That regulatory burden is massive, it's subjective, and it could scare off legitimate investors just as much as strict rules would. It's just far better and cleaner to maintain a strong, clear line. If you want the tax benefit, you commit the capital to the risk and reward of the domestic equity market, period. If you allow cash, the RIA just becomes a toll booth. Investors pay a tiny fee in domestic stocks just to get the huge tax break, and then they drive most of the money right back out the gate.
I'm just not convinced by that because you're prioritizing, regulatory simplicity over economic effectiveness? The government has to be pragmatic here, and they're already showing that they are. Look at how they're designing the RAI itself. They're making it user-friendly, letting people open only one account across all securities firms, which simplifies things. Extending asset eligibility fits right in with that pragmatic, user-centric approach. It's all aimed at maximizing signups and, crucially, maximizing that dollar inflow.
Okay, but...
And what's more, the risk of churning is already managed by the policy structure. The tax benefits are phased. You get a 100% reduction in the first quarter, then it drops to 80%, then down to 50% in the second half of the year. This tiered system inherently encourages quick, large-scale participation and discourages cycling funds later on. It ties the subsidy to a genuine, immediate, long-term intent, regardless of whether it's 100% in stocks or a blend.
That tiered structure is a mitigating factor, sure, but it doesn't eliminate the core problem, especially with cash. When you incentivize people to bring capital home, you have to define what home means for the policy to work. If the funds just sit in cash, they are, yes, technically repatriated, but they're not contributing to the growth of the Korean economy. They're just parked, earning almost nothing, and ready for an immediate exit. This brings us to contention 3, the broader market context and what kind of investor behavior we want to encourage. You mentioned the dramatic figures on risk aversion, and I agree, they're stunning. Gold bar sales this year hit almost 678 billion won, over 4 times last year's total. And silver sales, like you said, are up 38 times. You argue this environment demands that the RIA offers stability.
Absolutely. It demands stability within the account itself. The policy has to target investor psychology, not just abstract market mechanics. If investors feel safer bringing their funds home, knowing a portion can be protected in low-risk bonds or cash, they will participate. That psychological safety net is the only way to get the scale of capital repatriation we need.
That's an interesting way to put it, though I would frame it completely differently. That high demand for metals in dollars is evidence of massive liquidity chasing safety. And that liquidity should be actively channeled into productive investment, not just rewarded for seeking passive, non-growth assets. We should be using this powerful tax incentive to redirect that safe haven demand specifically toward our domestic equity funds, leveraging the stability and growth that actually exists in our core industries.
But what about?
Let's look specifically at the semiconductor sector. We're not a static economy. Giants like Samsung and SK Hynix are set to start HBM4 mass production as early as next February. They're pursuing technological leadership. The domestic market has dominant, world-leading, long-term growth assets. The RIA should be laser-focused on channeling capital to these productive parts of the economy, not allowing the subsidy to just reward currency parking.
But for many people, even with the long-term potential of HBM4, a 70% commitment to high-growth stocks is still too high a hurdle. We're talking about retail investors who've been burned by volatility before. If the policy fails to attract the volume of capital needed to stabilize the yuan, then the whole equity market stimulus argument becomes kind of secondary. We need the dollars back in the system first. A mixed asset structure just guarantees higher enrollment and higher repatriation, which remains the crucial factor.
I just don't agree that the equity stimulus is secondary. Diluting the requirement devalues the tax break and opens the door to misuse. If the government is willing to overlook that risk and rely on cumbersome checks of people's total overseas holdings to prevent abuse, it suggests the policy design is flawed from the start. A tightly targeted benefit encourages targeted, productive behavior. Loose criteria breed complex loopholes, which ultimately cost the taxpayer more for a less effective outcome.
But we have robust mechanisms, like the phased tax reduction, to ensure that long-term commitment. Allowing flexibility just broadens the tent and acknowledges the real psychological barrier that's preventing mass repatriation right now.
And I believe that flexibility fundamentally undermines the economic purpose of the subsidy by rewarding repatriation instead of market commitment.
So, to summarize my perspective, it seems pretty clear. The government's priority is FX market stabilization. Officials have said repeatedly that bringing dollars into Korea is the crucial factor. Expanding the RIA to include safer assets is a necessary, pragmatic concession to risk-averse investors. It ensures higher participation and increases the capital volume brought home, which is the immediate economic need.
And conversely, I just keep coming back to the fact that if the main tool here is a significant tax incentive, up to $50 million tax-free, then the investment requirements have to stay rigorous and focused on growth. Diluting that focus, especially by allowing cash, risks turning the RIA into a vehicle for tax-protected dollar parking rather than actual domestic market stimulus. And that just invites complex enforcement issues and squanders the value of the subsidy.
The final shape of these RIA benefits, whether it remains strictly focused on stock growth or expands for broader capital repatriation, will ultimately define its success.
And we await those critical details as the law targets passage in the National Assembly next February.
All right, so that's what's been going on with these critical capital flow policies and the very controversial repatriation investment account.
We'll be back soon with more analysis on the implications of Korea's newest financial regulations.
Thanks for listening. See you next time.